This relationship between Bitcoin and global M2 it's uncannily close. When you see a chart like this between some kind of corollary relationship between two assets, you don't see it very often. And when you do see it, even if you may disagree that global M2 is the best measure for global liquidity, because it isn't a measure for global liquidity, and I'll explain why, this relationship is still interesting. And so that's why I continue to post this chart. Not because I think it's gospel, not because I think people should trade off of it, but I think it's more so interesting because of what it tells us about.
You sort of said, okay, global M2, it's not your perfect metric. And you said something about it's not even a liquidity metric.
Liquidity is not global money supply. Liquidity is something different. It's balance sheet capacity. And that basically means
Joe Consorti is a rising star in the Bitcoin and finance world, with a sharp eye for macro trends and deep expertise in the Bitcoin market.
He's been a key player in developing an innovative asset-backed liquidity metric, reshaping how we understand market liquidity.
we figure out what global liquidity is by taking all these global central bank balance sheets, taking the price of the asset that is on all those balance sheets, and then taking the volatility as well. And by putting all of those three inputs into a metric, we can get a more accurate barometer for what global liquidity is.
If I zero in into these two last metrics that you mentioned, the 10-year treasury yield, the futures that you're looking at, as well as the move index for volatility, like what is it that you're looking for?
And so that's why it's so important to factor both of these in, because both of these, more so than the absolute level of assets, that tells us more about the proclivity for banks to lend. Because from global M2, we get no insight about banks' proclivity to lend.
Hey guys, welcome back to Less Noise, More Signal. Today with Joe Consorti. Really nice to have you on the show, Joe.
Yeah, absolutely, Pawek. It's like we both have been following one another's work for a while. We've been DMing for, I think, like 3 years now, or more than 3 years, and then we met in person. And we ran into each other so many times. We just talked so much about macro and Bitcoin and what are your thoughts on this? What are your thoughts on that? And so it only made sense to jump on a podcast and, get our thoughts out there on the air for people.
Yeah, exactly. No, cool. Real cool that we finally made it. Yeah, exactly. You were saying we were met in MENA, I think in Abu Dhabi it was, which is interesting to talk to you in person. As you said, for the first time. And so, I really thought I have to bring you on in terms of, talk about all the liquidity stuff, which is sort of the talk of the town lately. Everyone is sort of, referring to it when they talk about the Bitcoin price, because it seems to be a sort of perfect barometer, for what's going on and Bitcoin as well. And so this is what I wanted to talk to you about. So maybe, I don't know where we want to start. You want to give us a quick overview in terms of, what's been happening? Because I think you also had this chart that you were sharing back in November, December, where you were sort of pointing to the fact that it's bifurcating a little, the liquidity situation, and then also with Bitcoin, the price. And this now has come to fruition, and maybe now you can give us another update. That would be great.
Yeah, absolutely. So I'm gonna share my screen so I can show the chart while I talk. It's really interesting, right? I made this chart kind of on a whim. Basically, the Bloomberg has this global money supply aggregator. It literally just adds up global M2 of like G20 plus, like G20 and a bunch of different satellite global central banks balance sheets, and says, all right, here's the global money supply. This excludes China, actually. So that's why you don't see, any major change when China changed its global M2 measure. Going further that, so basically, this relationship between Bitcoin and global M2 is, it's uncannily close. Whoopsies, which is not something you generally see. It's not something, it's when you see a chart like this, between, some kind of corollary relationship between two assets, you don't see it very often. And when you do see it, even if you may disagree that global M2 is the best measure for global liquidity, because it isn't a measure for global liquidity, and I'll explain why, this relationship is still interesting. And so that's why I continue to post this chart, not because I think it's gospel, not because I think people should trade off of it. Of course, nobody should take any of this information and trade off of it, right? Or even predict where Bitcoin's price is going to go. But I think it's more so interesting because of what it tells us about how the market is treating Bitcoin, how it's beginning to treat Bitcoin at the margin. If you'll see here, if you go all the way back to, I could go further back than this, but let's go back like 5 years and some change. If you go back, 5.5 years, you can see that basically global M2, right, which is here in white, and then Bitcoin, which is, fittingly here in orange, there isn't really a relationship at all. There's a directional relationship, right? But Bitcoin's really kind of doing its own thing. Global M2 is, slowly, steadily moving up and to the right. Bitcoin is really high beta around all of that, right? So global M2 is moving higher. Bitcoin shoots higher, shoots down, shoots higher, shoots way down. And global M2 is largely moving in a very similar direction. And then you and I both know what happens kind of toward the end of October or end of 2022, October 2022, October and November 2022, FTX collapsed. And that was basically the final nail in the coffin after what was a year, if not, a summer and spring of these crypto bucket shops rolling over and exploding. Since then, right, basically since then, the relationship between Bitcoin and global M2 has connected quite a bit. More than anything, it started over here. It started in July of 2023. And I'm not exactly sure what caused it. If you'll recall, toward the very end of 2023 into 2024, the spot Bitcoin ETFs were becoming closer and closer to actually becoming instruments, right? They were coming closer and closer to fruition. But it wasn't until, I would say this relationship actually closed up, I would say, 5 months before that even happened, right? 5 months before the spot Bitcoin ETFs became a thing. Global M2, right, largely because of a bout of dollar strength, was declining. This is global M2 denominated in dollars. And then Bitcoin, had this bout where despite global M2 weakness, despite dollar strength, Bitcoin was rising. And so since then, these two assets have been very, very tightly correlated, I would say. We had this period in, earlier this year where Bitcoin kind of had its own bout of strength. To me, all this was an event like Trump's strategic Bitcoin reserve being heavily rumored. That's enough to cause people to want to front run the news and get in. It's a classic, sell the news event, and then it actually happens, and people go, okay, great, it happened. I'm going to sell now, right? That's sort of, it seems like what happened. And so to me, this relationship is still largely intact. You can see Bitcoin fell. It fell all the way down to, I think 77K was its local bottom, and now it's turning back up, which is directionally the same place that global M2 is headed. And so while it might not be, as tightly correlated as it once was, and the cool thing about this chart is I haven't made any changes to it since I struck it last July. So the first time I made this and I posted it, haven't made a single change to it. It's been extremely interesting to follow this directionally. So it might not be as closely correlated to it like 1-to-1, but it certainly is moving in that direction. So it begs the question, it begs the question, like, why? Why is that happening? Well, to me, it reflects a couple of things. One is Bitcoin's maturation as an asset, namely, right, the launch of the spot Bitcoin ETFs. You could see throughout the entire, basically the end of winter, spring, and early summer, as Bitcoin was consolidating, so too was global M2. It was kind of just chopping around. And then, when global M2 was on the move again, Bitcoin was on the move. This relationship doesn't mean that, global money supply was expanding, therefore Bitcoin was appreciating in value. That's not what it means at all. What it does mean is that as the dollar was strengthening, banks were less inclined to extend loans, right? When the dollar strengthens, right, it's because rates are climbing. And banks are less inclined to extend loans into the real economy. People are less inclined to buy risk assets, and because rates are higher, that's where they park their money, right? And then as the dollar weakens, global M2 rises because this is denominated in dollars. Because right now, basically, global central banks in tandem are either tightening their balance sheets or leaving them on hold. There are very few global central banks who are expanding their balance sheets, and so this whole relationship you see here, especially over the last year and some change, isn't global M2, like actual global money supply, like, envisioning a huge pile of dollars shrinking and expanding and Bitcoin following it, it's actually just lending activity. And when lending activity expands because of falling interest rates, then Bitcoin appreciates alongside that, right? And when lending activity contracts, the exact same thing happens. The opposite happens, rather. So it begs the question, like, is global M2 actually, that's what it tells me. It tells me that this is getting more institutionalized. And it's also, to me, even though global M2 is not the best metric to track this, and I'll explain a better one in a second, it tells me that Bitcoin is actually fulfilling what it set out to do. The message that was included in Bitcoin's first block was Chancellor and brink of a second bailout for banks, right? Bitcoin was kind of envisioned as the ultimate hedge against monetary debasement, right? In the wake of the global financial crisis, it's no coincidence that Bitcoin was launched at that time. It was launched at that time because the world needed something they could park their money in that couldn't be diluted. That's Bitcoin. And so it's kind of the ultimate fulfillment that as global lending activity expands and contracts, Bitcoin is following it because that's what it was designed to do. And so even though this isn't the most accurate metric for tracking this, it's one of the better ones that we have available. And to me, it speaks to both the institutionalization of Bitcoin as an asset, and also Bitcoin finally coming and fulfilling its relationship, or fulfilling what its monetary properties have always allowed it to do, which has become this apex hedge against monetary debasement.
No, that's amazing. Yeah, thanks for sharing this chart. And obviously, I mean, it's undeniable that there's sort of this correlation as we can see here. But then I want to come back to what you said, and I think you were already alluding to it, but you sort of said, okay, M2, global M2, it's not your perfect metric. And you said something about it's not even a liquidity metric, so to say. Can you elaborate on this, what you meant by this? This show is brought to you by NewHedge. In a market driven by complexity, insight is everything. NewHedge is a dedicated Bitcoin analytics and intelligence platform delivering cutting-edge analysis, on-chain metrics, and real-time market data. With 200 plus proprietary indicators, live derivatives data, and adoption metrics, NewHedge provides the depth and precision that serious market participants demand. Backed by some of Bitcoin's most prolific investors, NewHedge connects traditional finance with Bitcoin's evolving landscape. Gain your data edge today. Sign up for free now at newhedge.io and get 50% off your advanced subscription with the code SIGNAL.
Absolutely. So basically, M2 money supply, it just includes things like cash, checking deposits, readily convertible, basically money-like instruments. It doesn't actually measure balance sheet capacity, which is the ultimate factor that influences lending. And so if we look at M2 money supply and we see it rising and falling, we understand that that's happening because money gets lent into existence, right? We live in a credit-based global economy. When global M2 is rising and falling, it's because lending conditions are changing. But that said, it's only showing us these money-like instruments. It's only showing us cash, CDs, things that are basically close to money. It doesn't actually give us a picture of what lending conditions are like. It's not actually showing us the balance sheets. And so a lot of the time people will call global M2 liquidity. People will conflate money supply and liquidity quite a bit. At TBL, what we use is basically this definition, which comes from Michael Howell, and we've kind of expanded on it and then created our own metric for this, and I'll get into that as well. Money supply can be thought of as basically global cash and cash-like instruments, right? That's what the global money supply is. It's always rising, it's always expanding. But liquidity is not global money supply. Liquidity is something different. It's balance sheet capacity. And that basically means the amount of loans that can be extended based on global balance sheets. And that's not only influenced by the size of the balance sheets, but the stability of the assets that are held on the balance sheets. And so what that means is, let's say in order to get a measure of global liquidity, the best way to do it, and what we've actually done, would be to basically tally up the world's largest balance sheets at central banks. So the Fed's balance sheet, China's balance sheet, the ECB's balance sheet, adding all of these things up, and then factoring in the price, just inverse of yield, the price of the collateral, or the assets rather, that are held in these balance sheets, which is usually U.S. Treasuries, usually closer to the middle of the curve or toward the long end. So let's say the price of the 10-year U.S. Treasury and the volatility of the 10-year U.S. Treasury, right? Which we can extract from the MOVE index. So basically, we figure out what liquidity is. We figure out what global liquidity is by taking all these global central bank balance sheets, taking the price of the asset that is on all those balance sheets, and then taking the volatility as well. And by putting all of those three inputs into a metric, we can get a more accurate barometer for what global liquidity is, what the global lending conditions are. And that is ultimately more upstream than global M2. Global M2 is more downstream. Global liquidity is causal, right? And so whereas global M2 is just basically a downstream effect of what's happening with global balance sheet capacity or liquidity. And so what we're looking at here with Bitcoin and global M2's relationship, it's not as direct as the chart make it seem, right? This chart right here is delayed by 10 weeks. So Bitcoin is basically set backward by 10 weeks. The direction of global M2 has largely, at least directionally, showed us where Bitcoin's going to go. But with global liquidity, right, which again is upstream of global M2, because that's what influenced the amount of cash and cash-like instruments that are in the global economy, we can actually get an even further look out at what's going to happen in Bitcoin and other risk assets too. And because, again, it's basically like the pulse of global lending. What's going to happen with global lending? Because what's happening with global central bank balance sheets? Balance sheet capacity matters more than anything because we live in a global credit-based economy. And so that's why that metric is better for kind of gauging where risk assets are headed, because it is more upstream than metrics like global M2. The reason I use this chart is a really simple one. It's because I can assemble our metric, our TBL liquidity metric, in the terminal. I can aggregate global M2. I can't look at all of these central bank balance sheets. I can look at the Feds and the ECBs, but I cannot look at other key central bank balance sheets like China's, or at least very accurately. I can find that information elsewhere, and we do find that information elsewhere in order to assemble our own proprietary metric, but that's why I use Bitcoin and global M2 rather than our TBL liquidity metric. But if I was going to do that, we would see an even stronger correlation to Bitcoin, and we could get an even better sense of where Bitcoin is heading even further in advance.
Yes, I see. Well, very interesting. Yes, I mean, what you're referring to with your TBL metric is sort of the asset-based liquidity metric. Is that correct, right?
That's correct, yeah.
And I think I want to double click on this for sure as well. But maybe one last question, in terms of the liquidity and the effects that you were describing, also when it comes to the downstream and upstream effects, because the thing is, what I'm hearing a lot, like people, as I said, they're looking at this metric, they're seeing it, it's sort of a snapshot as we have here, and then they're sort of projecting into the future because it's slow, and then slagging Bitcoin has to sort of go up, and the easy layman thing that I want to throw at you is just like, because Bitcoin is probably this perfect financial liquidity barometer, as you said it yourself, and it was envisioned that it sort of means that when Bitcoin is going up, this is also the signal itself, that like liquidity is actually increasing, but then it's really the Bitcoin price itself, which is indicating this. And obviously a lot of people would love to know beforehand, before the Bitcoin price has increased, is liquidity sort of increasing? And so maybe you can talk to this once again, like how much is it sort of a forward-looking metric in that sense, or do we obviously need to factor in a lot of other things, as you said, like balance sheet capacity, and then also, okay, qualitative approach, so like, how is the economy doing after all? Maybe is regulation changing that sort of could allow banks to lever up and stuff like this? And it is probably thousands of factors which are really important here, but I hope you're trying to, or you're getting what I'm trying to get at, with this question, like how much is the Bitcoin itself is already the liquidity measure, so to say,
It is exactly right. Like when we think of Bitcoin, it's basically the world's first. It's the world's first 24/7, 365 global asset that is also highly liquid, which wasn't the case even 5 years ago, even 10 years ago. It's now a $2 trillion asset. Yeah, right around like $1.9 trillion asset. And it is also absolutely scarce, right? That's the key. People have a reason to buy it and own it and hold it. That absolute scarcity is probably one of the more important things. It's global, right? So because people from all around the world can buy it, it is it can be a very accurate reflection of global lending conditions, more so than if it was just like a US based asset, for example. Because it's totally digital, it's totally online, like it's instantly sellable across space. It can be settled near instantaneously anywhere on Earth. It also makes it a little bit more accurate than, again, if it was just a US based metric. And then, we have to consider the other side of the equation, right? So what is Bitcoin ultimately measuring? Like you can honestly throw out all of this. You could throw out global M2. You could throw out any measure of liquidity and just kind of take Bitcoin as a measure for where global central bank balance sheets are headed. We're in a world of perpetual monetary debasement by design. We need rates to be falling forever. And now that we're at the zero lower bound, we're kind of in a bit of a pickle. Every global central bank or every world government, particularly the US government, has a mountain of debt that it needs to refinance at lower and lower and lower rates. And now that we're at the zero lower bound, we basically have a central bank that needs to begin stepping in more and more as the marginal buyer of all of that. So we basically live in this world where we need to lend an increasing amount of money into existence, and we need to do it at an ever lower rate. And so because of that, Bitcoin is it's inevitable, right? This phrase Bitcoin is inevitable has been thrown around quite a bit. But you could very well, because of that, now that we can see it's kind of fulfilling what its monetary properties have always allowed, you can honestly throw out global M2. You don't need to track this relationship. You don't even need to track its relationship with liquidity. You can just take Bitcoin as the metric of where, global money supply is headed, where global balance sheet capacity is headed, what it's doing. Obviously on a bit of a delay, because it takes time, right? It takes time for money to be lent into the world economy, and then ultimately, Bitcoin to be purchased as a result of people trying to seek a hedge against that. But if we are looking for a more accurate way to gauge where Bitcoin is headed, to basically, it's not even to gauge where Bitcoin is headed. It's just to gauge where all assets, generally speaking, are headed, and where global lending conditions are, where they stand, right? How much money can be lent into the real economy. I'll go through the inputs of TBL liquidity in detail. So input number one is Fed assets, right? All of the assets on the Fed's balance sheet. And we use a weekly resolution for this. Number two is U.S. commercial banking assets. And you'll notice that I'm using the word assets a lot. And this is because liquidity, our definition, our measure of liquidity, is an asset-based liquidity metric compared to global M2, right? M2, they're liabilities for U.S. commercial banks, right? And so it's not the best measure of actual money supply. If we take a look at assets, then we say, okay, now we know what banks can lend against, right?
And I think that's the important distinction right here, right? Because it's the assets that banks and it's probably banks or other financial institutions can lend against. So that's the collateral they have to extend credit, because that's how it works in today's financial system. And so that's why you're focusing on the asset side of things, right?
Exactly. M2, right? Cash and cash-like instruments, they may be assets for the public, but they're liabilities for the banking system, right? We want to look at assets for the banking system. And so that's the important distinction here. And so everything in the TBL liquidity metric, and other, really great prevailing metrics for liquidity, like Michael Howell's cross-border capital kind of liquidity measure, they're asset-based. The third is ECB assets, right? Again, another major global central bank. And then People's Bank of China assets on a monthly basis, because we can't get that, data weekly, unfortunately. And then China banking assets, right? And these are from non-central bank, basically non-central bank banks, like, the U.S. commercial assets that we use, U.S. commercial bank assets that we use, China banking assets, basically the exact same thing over there. And the final one is BOJ assets, right? Bank of Japan assets, and those also come in monthly. And so we have those 6 inputs, and then we add in, as I mentioned, the 10-year Treasury futures contract, and we use the price for that, right? We want to see basically what's happening to U.S. Treasury prices, because more often than not, the assets that these banks are holding, in large part, they are U.S. Treasuries, and so we use the 10-year for that. And then the final thing is the MOVE index, right? Bond volatility. And we use daily values for that as well. And so basically we aggregate all of these assets across all of these major world central banks from these nations, right? The US, obviously the ECB, PBOC, and Japan. And then we take a look at the price of the large portion of assets that they are holding via the 10-year Treasury futures contract. And then we factor in the volatility, right? And we basically take all of those inputs and we get our own TBL liquidity metric, which is a more accurate, more leading indicator of global lending conditions, and it can give us a better proxy of where we think Bitcoin's going to head. It's not as clean looking as this global M2 metric, but it does give us a far more a much bigger lead on where the world economy is going to head and where risk assets are going to head.
Mm-hmm. Yes, I see. And if I zero into these two last metrics that you mentioned, the 10-year Treasury yield, the futures that you're looking at, as well as the MOVE index for volatility, like what is it that you're looking for, in terms of both of these metrics? Like if prices of 10-year Treasury yield, the futures go up or down, what does it tell you? And the same thing with volatility. If volatility on the MOVE index is headed higher, what does it tell you? And if it's headed lower, then what sort of information does it give?
Yeah, for sure. So MOVE is basically the implied volatility in the U.S. Treasury market. Excuse me. And so basically it is taken from option contracts, and it reflects the Treasury market, like market participants' expectations for future volatility in fixed income. And so basically when this rises, people are anticipating the Treasury market is about to get extremely volatile. And what do banks do when they anticipate that? They go ahead and they extend fewer loans. They raise the rates on their loans because they anticipate a lot of volatility. They don't want to be lending anything in the environment. They don't want to be extending credit in that environment. And then when it falls, right, lending activity increases, right? The treasury market, whether rates are high or low, it's less volatile, and therefore, banks are much more inclined to extend loans there. The premiums that they charge on the loans they write are much narrower. And then the reason we take a look at the 10-year Treasury futures is the absolute price level, right? Because let's say rates right now are high, right? We could even take a look over here at the 10-year I have here. They're at like 4.3% now. I'll go back here so it kind of all lines up with what I just showed earlier with global M2, and then I'll show all the charts compared to one another. Let's say rates right now are at 4.32%. That would mean the price is at whatever level, right? If these rates were to fall, right, then obviously the price on the 10-year Treasury would rise and vice versa, right? If rates right now are to go all the way back up to 5%, which is what they were, around October, November of 2023, then obviously the price on U.S. Treasuries would decline. And that would mean a haircut for banks. And so that's why it's so important to factor both of these in, because both of these, more so than the absolute level of assets, that tells us more about the proclivity for banks to lend. And that's why liquidity is so important. It's more important than a measure like global M2, because from global M2, we get no insight about banks' proclivity to lend. And that leads to huge dislocations. As I mentioned, prior to the call starting, when I was just kind of waxing poetic about all this stuff, global M2 may be like on a total tear, but Bitcoin may be completely disconnected from it. Like the S&P may be completely disconnected from it. The reason being, rates may at the same time be skyrocketing. And if rates are skyrocketing, banks are taking a huge haircut. Let's say the MOVE index is extremely high and rising. Banks have no proclivity to lend. So people may look at the Bitcoin global M2 chart and say, whoa, Bitcoin isn't actually a proxy for global liquidity. Well, that's because the global M2 metric is not factoring these two things in. It's not factoring in the price of collateral and also the volatility of that collateral, right? And because liquidity metrics like Michael Howell's liquidity metric and TBL liquidity factor those two things in, it becomes a better measure for the lending proclivity at banks because it actually takes into account the price of the bonds that are on their balance sheet and the volatility of those bonds.
Yes, exactly. Yes, exactly. Yeah, that makes a ton of sense. Well, I mean, thanks a lot for sharing all these insights, and I mean, really doing this breakdown of the liquidity measures, so to say. Now that we know that the model, and the metric, I mean, and the audience might be inclined to know what is it signaling right now. Where are we going? What is sort of the thing that you're getting out of it that you can tell us?
Yeah, absolutely. So, in a time like today, right? We know if we go back to, well, okay, so there are a lot of places we can start, but I want to start here. QT is coming to an end, which is great. Obviously, QT, quantitative tightening, the Fed has been allowing assets on its balance sheet to mature, and then not buying assets to replace them. And so,
How important is that? Because that's exactly the question that I'm getting then. Well, yeah, QT seems to be slowing down. So effectively, it's almost like as if it's coming to an end. But then QE is not starting. It's not around the corner. So
exactly.
does it make a difference, like QT ending, sort of? Can you elaborate on that?
Absolutely. Yeah. So it does make a difference, right? So when QT is kind of winding to a close, it means the Fed so basically during QT, the Fed is allowing assets to mature off of its balance sheet. And then when QT is slowing down, it means that it's allowing assets to mature off its balance sheet, but it's buying new ones to replace them. And so it's keeping its balance sheet the same size. That's not QE. QE would be buying more assets for its balance sheet.
And
Then when it's
expanding it.
maturing, it would be expanding its balance sheet. And so basically, if you think about it this way, the Fed is going from reducing its balance sheet to not reducing its balance sheet. Not from reducing its balance sheet to expanding it, but from reducing its balance sheet, which is a net reduction in liquidity, to keeping its balance sheet totally, at one level, right?
Yeah, flat.
And so that is it's a shift from a tightening impulse to an easing impulse at the margin, because liquidity is no longer contracting, right? And because of that, that's a great thing for risk assets. It's a great thing for, global risk assets, particularly Bitcoin. Because when QE or when QT slows, rather, we've seen historically that Bitcoin does quite well in those periods. Bitcoin did pretty well throughout 2019 until obviously COVID hit. It did decently well through 2019 and early 2020 until COVID hit. Following or in the months leading up to the repo crisis, Bitcoin was doing quite well. And then something happened to the financial system that caused the Fed to flip back into QE. We'll see if that's the same case here. The last time the Fed ended QT and it kind of brought the program to a close was in 2018 into 2019. And then obviously in 2019, but it had barely kicked off. And then there was a cash shortage in the repo market. The Fed decided to expand its balance sheet once again. And then COVID hit, and it fired up all the printers. But basically, what we've seen now, this has been a much more slow and deliberate process of ending QT. It kind of started all the way back in like early 2023 when we had the blow up with Silicon Valley Bank. The Fed created its brand new facility at BTFP. And then all of a sudden, it expanded its balance sheet momentarily. But since then, it is reduced the size of its balance sheet. And it's also, reduced the rate of running down its balance sheet very, very, very slowly and methodically. So this has been going on for 2 years, compared to back in 2018, 2019, when the pace on a percentage basis of QT was much faster. And so I tend to think that the risk of any kind of blow up in the kind of like inner workings of the financial system is much lower.
Yeah.
And so for me, like, QT coming to an end basically says like all those risks are now behind us. Now we have this like easing impulse at the margin because QT is ending. That's great for risk assets.
But it doesn't mean exactly as you were alluding, that this means QE is starting anytime soon. Just because, as you were saying, because they were so deliberate and so careful in sort of scaling it down and scaling it back, it might have helped to avoid any sort of blow up. And that's why because QE is probably only going to happen if there's like a major blow up again, because something needs to break sort of for them to restart QE is probably the consensus view, right? And so because they were so good, let's put it this way, so good at scaling it down, that might be the point that it's not started, or it's not starting anytime soon, the QE stuff, right? Is that sort of a fair assessment, right?
Yeah, completely fair.
Yeah, exactly. Okay, yeah, no, exactly. But then, sorry, I didn't want to interrupt you. You were, I think, going on about the metric itself. Yeah.
Mm-hmm. Yeah. So that's the Fed's balance sheet. So over the next several months, I anticipate the Fed's balance sheet to stay totally flat, ceteris paribus, right? If something happens in the financial system, the Fed will be the first one to step in and expand that balance sheet, right? But I do think that over the next several months, we see a totally flat Fed balance sheet. Moving over to the dollar, because again, the dollar has been one of these factors that has really influenced global M2 to a pretty large degree. And it also, right, the strength of the dollar is very important. That's influenced by treasuries. I'll talk about two things here, and it mostly relates back to Trump. Excuse me. Trump weakened the dollar like the moment he got into office. So basically, the moment he got into office, and there's actually the chart I'm looking at, it looks basically the exact same from when he first got into office. And I'll share my screen here of the dollar. In his first term, Trump weakened the dollar. This is when Trump was inaugurated, right around here, like January 20th, and then it was a huge decline, right, all the way through early 2018. And he tried to he basically kept it much lower than when he was inaugurated for the entirety of his presidency until COVID hit. Right. So removing this from the picture, Trump likes a weak dollar, right? He likes a weak dollar because it's better for trade. It means that the U.S. Is much more attractive for the foreign importers, right, to buy our goods, right? And so that's good for U.S. manufacturing. In Trump's eyes, that's what he likes, that's what he wants, and that's what he's trying to do again. And so for me, I view the dollar as continuing its descent, right, which we've seen here. Since Trump was inaugurated on, right around January 20th, somewhere around here, the dollar has been in decline. I believe we're going to see a very similar thing to the first Trump presidency in that respect. Moving over to the 10-year, I similarly think, but to a lesser extent, that the 10-year will be on the decline. Obviously, with the 10-year falling, that obviously means that people are less enthusiastic about the growth prospects for the U.S. economy. That's not necessarily something that, as much as Trump wants to weaken the dollar, he probably doesn't want to bring the 10-year Treasury yield down too much, right? You can notice that even as he brought down the dollar, tens were basically not, they were not moving down to nearly the same degree as the U.S. dollar was. If I flip back to this chart, you can see that in the period that the dollar went from all the way up here, like 1200, to, let's take this, 1100, tens moved from 2.5% to 2.6%, right? So it's not something that, as much as Trump wants to weaken the dollar, I don't think he wants to bring down rates as much. And obviously, Trump has way less of a hand to play in the front end than he does the long end of the curve. That's much more about what policies the U.S. government implements in order to influence growth. In the prior administration, that wasn't really the case. But one of the things that Scott Bessent said when he came in was, the Fed can take care of the front end, we'll take care of the long end. And what that means is that basically Trump's cabinet is saying, like, we are going to influence economic policy and the growth outlook for the United States way more than the Fed could ever hope to. They can take care of, the basic, overnight borrowing and lending rates and short-term borrowing and lending rates. That's fine. But we're going to handle the economic growth outlook for the United States. And so far, it appeared that that's largely what they've done. With this pretty massive descent in the U.S. dollar, we haven't seen as much of a decline in the 10-year yield. Granted, it went from 4.5 to 4.3, but I do think they're going to try to manage the dollar lower to make the United States more attractive on the global stage for importers, but keep tens at a pretty healthy rate in order to incentivize long-term investment in U.S. Treasuries and also keep people enthusiastic about the growth prospect of the U.S. economy.
Yeah, exactly. That's probably exactly right. Because like, as you said, like Scott Bessent himself, he said that they want to take it lower. But there's the question really is, how to what extent can they really do it? Probably on the long end better than the Federal Reserve. Yeah. Like the government itself with the policies that they're sort of announcing and everything that they're doing. But in the end, it's really the question to, how low are they willing to go? And I would have a similar hunch that it's probably not as low as some people might be expecting, or not that it's sort of coming into sort of recessionary environment, where people would sort of start to freak out. So that's probably also my base case, that it's going to, just sort of jog along, and that's probably, as I understand, yours as well.
Mm-hmm.
When it comes to the move index, I think that's the last input that you're looking at, right? Maybe you can elaborate on this as well.
Mm-hmm. Yeah, I can go ahead and pull that up while we're chatting here. Take a look at the move index.
Yes, exactly. No, I mean, because that's something usually people, they have been hearing about this, but there's not that much focus on it. But as you were describing it, it makes a ton of sense, because in the end, volatility is really important. Also, it's sort of an input in how big the haircuts are going to be for collateral that's being used in the financial system. So obviously an important metric to look at. So
Exactly. Yeah.
makes sense.
I've got it up now. I'm going to go pull it up here. In 2016, one of the interesting things was the move index had a big spike when Trump was elected. Once he got into office, it actually was on the decline for the entire year. And so he was able to keep the U.S. Treasury market tame while managing the absolute level of the U.S. dollar relative to other global currencies lower. You can see here when Trump was elected back October, November, move index spiked pretty hard. This is from the end of October into basically election week. And then you can see once he was actually inaugurated, it had this huge decline, which obviously influenced, lending conditions to loosen up. It incentivized, lending, which obviously led to good economic growth. That was basically the MO of Trump's first term, and that's what he was able to achieve. Similarly, we can kind of see a really big spike around election day. What do you know? And then since then, they've come lower, right? The move index is a little bit higher than when Trump was first elected. But I imagine that the Trump team will be wanting to create a similar regime of basically low volatility that it had here. We started to see bond volatility rise a little bit in the summer when there were issues bubbling up, and then basically in the lead up to and during the repo crisis in 2019, bond volatility exploded. It managed to come back down, and then COVID hit. And so, but if we ignore all of these other events, right, from the Trump's economic policy perspective, you could see that he's a big fan of keeping bond volatility low, right? Jerome Powell under Joe Biden, not so much, right? You can see bond volatility extremely high. Obviously, we had Powell raising rates and then, extremely aggressively keeping them there. And only now has it started to kind of channel down, now that we are in the period of we're lowering rates. We want to take, basically Fed members are saying that the Fed funds rate is going to be 100 basis points lower than it is now, by the end of the year. And so we are now in the phase where we're no longer tightening, we're easing. We have a clear path as to where the Fed wants to take it. Bond volatility is decreasing ever so slightly. I tend to think that that's going to continue, right? And again, ceteris paribus. If an event doesn't happen, like something in the repo market or something somewhere else, deep in the shadows of the global financial system's plumbing, or another global bioengineered pandemic doesn't happen, then I think the path of least resistance is for it to continue going lower, which means more investment in the United States, more lending, which is obviously great for liquidity, and then pair that with Trump's weakening dollar. It's kind of off to the races for the U.S. economy and for risk assets too.
Yes, I see. And any thoughts on the measures that the Trump administration is taking or can take, to bring down this, like the bond volatility into the lower bound territory that you were showing there? Like, what is on the menu, so to say?
Right. one of the things that Trump has done, and he did it in his first term, was basically like yell at Jerome Powell constantly to bring interest rates down. Powell was going to do that anyway, but I think now that there's like extreme consensus from the Fed and the president, and the U.S. government itself, the executive cabinet, the executive branch rather, I think that makes for lower bond volatility overall. Because when Powell was raising interest rates, what were the Democrats telling him to do? What was Joe Biden telling him to do? They were yelling at him to lower interest rates, and that makes bond investors nervous. That makes bond investors, go, whoa, I probably don't want to buy, bonds right now. I probably don't want to buy treasuries right now. As rates are skyrocketing and there's a huge disagreement between the executive branch and the Federal Reserve, I'm going to lay off. And so even though rates were climbing, new issues had much higher yields attached to them. People were also selling off treasuries like really quickly. They didn't want to own these things during that time. And that exacerbated the climb in the MOVE index. I think now that there is consensus, even though it's, Trump's version of consensus, where he's yelling at Jerome Powell to bring rates down, or he's saying, at the end of your term, you're gone. I'm not letting you stay here for another. I think that now both sides are in consensus. It's gonna bring down MOVE quite a bit.
Yes, makes a ton of sense. Well, I think, Joe, that was great. There's 40 minutes in, so I don't want to artificially make it any longer. I think that was a great sort of overview, and that's just an understanding of how to adequately measure financial liquidity and how to properly look at it. So thanks a lot for doing this. I think any last things that you want to share with the audience before we close?
Yeah, absolutely. Well, thanks so much for having me on. I think this was a topic that needed to be discussed, and I loved discussing it over a period of 40 minutes. Other resources that I would point people to, because even though I've been working on this for a couple of years, I'm by no means an expert. I would take a look at some of Nick's writing over at the Bitcoin Layer, thebitcoinlayer.com. I would take a look at Michael Howell over at Cross Border Capital. He's on X at Cross Border Cap, and you should subscribe to his newsletter as well if you want to really understand these things. Because it's one thing to shout from the rooftops that money's going to be printed forever. Look, money's being printed. Bitcoin's going to go up forever. It's much more valuable to actually understand the mechanics behind this. And even deeper than today's episode, if you found it intriguing, I would really encourage you to go read some of those materials. Cross Border Capital, the Bitcoin Layer. Go read up on what those guys over at Cross Border Capital and we at the Bitcoin Layer have written about it, to get a deeper understanding of how all this stuff works, so that you're better prepared, right? And yeah, I'll leave it at that. Thanks so much for having me on.
No, that's great. Yeah, we got both of these guys. We already had them on our show, and hopefully in the future we can bring them back on. So that's amazing. So Joe, I think that's been great, and so have a great one. See you soon.
You too. Talk soon.
Thank you. Bye.